We've said we'll do it for several weeks. We're here to do a deep dive on SOFI in the 1st of June, 2026.
It's a 10 Mil Club.
Weekly Deep Dive.
Thanks for joining us. We're glad you're with us. The 10 Mil Club is an informal group of people who all believe that if we could get to $10 million of net wealth, we would have the financial freedom that we desire. Be really careful because there are some valuations that are shown in this video. They do not conform to any of the standards or ethics of any of the valuation professional organizations to which I am beholden, and I'm not showing all of my work at all. But we need to get into SOFI and why SOFI is doing what it's doing, let's go with a quick overview. SOFI is essentially a technology-based bank. It's a diversified bank, and it has three segments. The lending segment, which is personal loans, student loans, home loans. The technology platform segment, I'm a little unclear, if I'm being honest, what the technology platform segment does. They just simply said that there are various platforms and products. And the financial services segment, which is where they have checking accounts, savings accounts, investment accounts, and SOFI crypto. They recently released their own cryptocurrency, or their own stablecoin, I guess you'd say. And the question is whether it will catch on or not, whether people will use it. These are some really important dates, or time eras anyway. June 2021 is actually important because that is when SOFI IPO'd by SPAC merger. A SPAC merger is when you don't do a traditional IPO, you actually reverse merger your company into an empty company, and with that are able to go public a lot faster than you might otherwise be able to. What that means, though, is that from the beginning of 2022 on is really all of the decent financial figures that we have on SOFI. Anything before that, we have them because they're required to give them, but they really are almost fake news. It just is something that we really can't rely on. In late 2025, Chime, which was using SOFI's processing platform, finished its exit. There wasn't really a date that Chime really announced that they were going to leave the platform, but they kind of started leaving the platform. And let's go to SOFI here. This is a year of SOFI. This is the end of 2025, right about here. And right at the end of 2025, Chime announced that they would be leaving SOFI's platform. I'm sorry, they finished leaving SOFI's platform. They began leaving SOFI's platform somewhere back this way. They then paid a fee of $18 million termination fee in March of 2026, which is around in this area right in here, as a final goodbye in their contract to SOFI. And importantly, they as they were paying that fee and finalizing it, Muddy Waters, which is a short sale firm, issued a short report on them on March 17th, 2026, which SOFI's management refuted that very same day. Following the refutation, within a week or two, Muddy Waters came back and kind of pointed the finger and said, you didn't give us any answers, you just kind of threatened us. And so there's been this kind of back and forth between Muddy Waters. Just, if I could, about Muddy Waters for a minute and the likes of Muddy Waters. Muddy Waters and their type are short sellers. They make no bones about the fact that they are biased. In fact, in the disclosures in the beginning of their report, it's about 28 pages long. Now, I'm going to be perfectly honest, I did not read every single word and get down in every single number of Muddy Waters' report. And that's part of what they're counting on, really, is that you don't know what ASC 804 really is. Muddy Waters makes a lot of claims, and they do it over 28 pages. I'm going to talk about that in just a minute, but the point is this: they make it very clear that they are biased and that they are short SoFi stock. So they just so that we're all clear, they don't lie up front about that as to whether or not they're holding SoFi stock. So they are short SoFi stock, and they let you know it. So anyway, that's kind of the timeline, and that's really important to understand. Let me talk about some fundamentals just for a minute. These are SoFi's fundamentals as far as an annual is concerned. Now, there's a lot of numbers on this page, and I don't expect you to really dig into all of these numbers. I'm just going to point a few things out. Anything before 2022, we said SoFi went public in a SPAC merger in June of 2021. So you kind of have to draw a line between 2021 and 2022 and go, okay, anything before 2022 is just not of any use. This second line, you can see the share count. Weighted average shares out is that third line down, I believe it is. You'll see it. You can see how the share count increases from 900 million shares to 945 million. 900 million shares, 945 million shares, up to over a billion, 50 million shares, then a billion, 1 billion 150 million shares. And they have continued to do that. I'll show that in the next piece, but their revenues also continued to increase. And for a while, they didn't have positive EBITDA. You can see the EBITDA, and you can see the EBITDA per share number down there. For the last 2 closed years, they do have positive EBITDA. You can see that about midway down the chart. You can start at about $760 million worth of EBITDA, and the year before, $436 million worth of EBITDA. But before that, there is no positive EBITDA. That's actually important as well. Another thing that's important, if you look down at one of the last lines, debt to assets, they had some debt. They don't have a whole lot of debt. Now, the vast majority of SoFi's debt, if you will, is actually accounts in the banking world, accounts that people bring their money to you. It sounds like a great thing. They bring their money to you, and it gets deposited, and then they can use that money to make loans and things like that. And that is how they run. But you do need to know that those on their balance sheet, those accounts are actually debt that's owed in a form, but they don't have a whole lot of really long-term debt. And so anyway, an improving company. These are their quarterly fundamentals. Just again, a lot of numbers on a page, but we're just to go. You can see in the top line underneath the dates, you can actually see the share count increase. That's not really uncommon. There are a lot of situations where companies increase the share count, especially with a younger technology company. That's really common. So don't necessarily be off-put on that, except for the fact that it does dilute what they're doing as they go. But you can see the revenue increase in the second line, revenue increasing from the December 2023 quarter of $600 million all the way up to $600 million all the way up to $1,408,000,000 in the March quarter. And the revenue per share actually increases as well. About midway down, you can see EBITDA and EBITDA per share. Those are much smaller back in the December 2023 and March 2024 area. And then now they have more EBITDA per share, and they're growing pretty well. Debt is relatively low. So what we have here is a company with a growing share count, which is not good for you, the person who buys it, but it's not like out of control, but it does grow. They have reasonably accretive share issuance, so their revenue per share is growing. Their EBITDA per share is growing as they go. And so what we have is a company that has improvement. They really do. But the Muddy Waters report is kind of a big elephant in the room. Now, just for a second on the Muddy Waters report. I tried to spot check some of the things in the Muddy Waters report, and I spent 1 year at a Big Four accounting firm doing accounting. I wasn't there very long, but I do have an accounting background. My MBA is my concentration was in accounting. So I'm not a babe in the woods as far as accounting is concerned, but when it gets into all of the financial accounting standard boards requirements and things like that, it takes a little while to come up to speed. And in truth, our goal here at the 10 Mil Club is to make as much money as we can, as fast as we can, because we are actually a bunch of appraisers, and we are painfully aware of the time value of money. So we there's just a anyway, so you need to understand that there's a lot of stuff in the Muddy Waters report, and they've put a lot of time into it, and it's a lot of nanny boo boo. It really is. It's just a lot of well, you're a poo face. Well, you're a dog breath. I mean, it really is that kind of thing. And look, their job is to be biased about it. And the thing is, we do still have free speech in the United States. We also have some counterprotective laws of slander and libel that can be used if someone doesn't have the goods on you. You can say what you want to as long as you don't threaten any kind of actual bodily physical harm on someone, but you are accountable for the things that you say. So that's that's the Muddy Waters report. Just to understand that. All right, this is SOFI over a year. Okay, price rises up here. We here at the 10 Mil Club make a few unsuccessful attempts at trading it, and then we go, something's wrong with this. And we just kind of get out of it, and then it does this down, and then kind of starts finding a footing on this longer term trend here. SOFI is actually in it's in a segment called the consumer finance sub-industry. These are the companies that kind of populate the consumer finance sub-industry. American Express is massive. It's kind of the leader of that sub-industry. Capital One Finance is there. Synchrony is there. Then SOFI is kind of right in the middle. Then you have some smaller ones, and kind of tried to demonstrate who's there. Ally is somewhat below SOFI, about half the capitalization. And then these other companies, First Cash, Figure, One Main, and Credit Acceptance Corporation. So just to kind of give you a view of kind of how that works. This is the industry itself, consumer finance. That's the consumer finance industry, consumer finance sub-industry. Looks kind of like this. This is a year. This is the same time frame we were looking at SOFI just a minute ago. The sub-industry itself doesn't look that different from SOFI. I mean, it does look different, but you can see a climb in the sub industry all the way up to the end of 2025, and then a fall in the sub industry. Not everyone has. So one of the things, I mean, if you watch Dave Keller as I do, and we strongly recommend that you watch Dave Keller's Market Misbehavior webcasts. He is really, really good. He has decades of doing this sort of thing and this sort of research. And so you want macro stuff, watch Dave Keller. The 10 Mil Club are big adherents to Dave Keller. But this is, so you can see the sector here, and of course SOFI kind of reflects the sector. Yes, there's SOFI. Not perfectly, of course, but there's SOFI. Now here's what's funny, just if I could, an aside for a minute. Like I said, not everything in the sector looks like that. There's a company called Bread, BFH. This is what Bread looks like. So lower left to upper right. This is a buy the dip stock, right? We're not here to do a deep dive on Bread at the moment. Maybe we should. But one of the things we like to send people away with is what are the better looking things of the sector. We don't even have Bread on that list because it's much smaller. But BFH, Bread. FCFS is First Cash. Lower left, upper right. All kinds of momentum. Probably worth looking into. Anyway. First Cash Holdings. One more, ECPG, is Encore Capital, lower left, upper right. Lots of momentum, probably a buy the dip stock. So we thought we'd leave you with those three just to kind of give you an idea of what we think maybe we really should be digging into in the sector, which is not to say that, we shouldn't be digging into SOFI. We absolutely can. But there's just, I want to show you this part right here. So this is they sit in the consumer finance sub-industry. This table over on the right, I know that's kind of a lot of numbers, but bear with me here for a second. So we really only have 4 years of valuation that we can run on the company. The share price right now as I speak closed at $18.58 today. Using their last 4 years of the company's price to revenue, this is the high, this is the low, this is the range based on the projections of the analysts that we follow. Midpoint is $18.16 by price to revenue, which is eerily similar to the current share price. By price to EBITDA, though, you have a much higher range and a much higher share price. Now, a comment for a second about that. We only have 2 years of positive EBITDA. So with only 2 years of positive EBITDA, it's kind of wonky with SOFI, and we just don't have we just don't have a lot of data to go on, and so what we found as we did this valuation here, and like I said, we're not showing all of our work, we are just giving a summary of it. What we found was that over the 2 years that SOFI does have a positive EBITDA, the price to EBITDA range declines significantly. Take a look at this area down here in the lower right, where we're talking about the comparables that we have here. We actually had 4 comparables, not 3. Sorry, that's a typo. But if we run a price to revenue band and we trim it one time, we take out the low and the high, we end up with a range that doesn't look too terribly dissimilar to the one up top, where we're basing it on the company's history from $26.60 to $9.72 with a midpoint of $18.16. We actually end up, based on the comparables, with a midpoint of about $17.79, which is eerily similar to the share price of $18.58. Go down to the very, very bottom, though, and the more established comparables that have more years of EBITDA and price to EBITDA to work with actually show this range right here, from $49.28 a share to $7.62 a share with a midpoint of $28.45. If you in your head are going, well, that means that the shares should be priced a whole lot higher. Well, by price to EBITDA, according to the comparables, yeah, probably so. But with the company's price to EBITDA being really, really high right now from a fundamental standpoint, not a technical standpoint, but a fundamental standpoint, that should put over the next couple of years some downward pressure on SOFI's stock until, barring just a technical takeoff, which is possible, it seems like SOFI probably should, barring some ups and downs, trade somewhat sideways if it just simply goes by the fundamentals. And we know that stocks don't do that. So there's a lot written out there about, I could show them Facebook page after Facebook page, Instagram post after Instagram post, X post after X post about SOFI is massively undervalued. Well, it kind of depends on how you look at it. From its past 4 years of price to revenue, no, it's not. Based on its comparables price to revenue, no, it's not. Based on its own price to EBITDA, well, that's sketchy because its price to EBITDA is actually very high compared to its peers' price to EBITDA. So there really should be downward pressure from a fundamental standpoint on SOFI shares. Those other ones we talked about, Bread, First Cash, Encore Capital, maybe we'll be looking into those. But with SOFI down here, it is a compelling look. It did jump over that line that goes back, like if we move that to 2 years, like this, you can see the underline, and it touches, then touches, and then finally breaks across that underline here with some momentum. You know what? We'll keep an eye on it, and we'll see if anything happens. But with the short report hanging out there, and I just don't know that we have enough right now from a technical standpoint to really buy into SOFI. But given enough upward momentum and enough, this is good volume on these few days here, but I would need to see just a bit more in order to actually buy into SOFI. But we'll keep an eye on it. So we're not writing it completely off, but there's just some question and concern. Fundamentally, the share price might be way down. The technicals would have to take off. We'll have to see what happens. And that is what we think of it from all of us at the TMC Control Room. We thank you for watching, and we will see you next time on the